Ledn's rated Bitcoin-backed security gave crypto lending a test inside traditional credit markets. The important shift is funding quality. Institutions are judging loan structure, custody, and transparency instead of chasing yield alone. Ledn identifies massive centers on a $188 million Bitcoin-backed asset-backed security and a lending model built around custody, reserves, and no rehypothecation. The first thing to separate is the trigger from the consequence, because the same event can affect users, traders, companies, or regulators in different ways. In this case, the pressure is specific. For borrowers, the model can unlock liquidity without selling Bitcoin, but trust depends on collateral storage and strict limits on reuse. That gives the story a clear reason to watch without turning it into a prediction. The anchor is not a mood shift. It is Ledn closed a $188 million Bitcoin-backed asset-backed security issuance in February. The confirmed details are concrete. Ledn closed a $188 million Bitcoin-backed asset-backed security issuance in February. The deal received an investment-grade rating. Outstanding crypto-backed loans reached about $73.6 billion by the third quarter of 2025. Those pieces matter together because one fact shows the event, another shows the context, and another shows why the market or user reaction was not random. A broad crypto audience does not need heavy jargon here. It needs to know which actor changed behavior and which part of the system now carries more pressure. The mechanism is straightforward. A rated security changes the funding channel because traditional investors can buy exposure to loan cash flows under familiar credit rules. Ledn has processed more than $10 billion in Bitcoin-backed loans since 2018. In plain English, the mechanism is the path between the headline and the real-world effect. If that path is weak, the story fades quickly. If that path is strong, the event can influence liquidity, access, trust, compliance, custody, or infrastructure beyond the first reaction. Timing also matters here because the deal received an investment-grade rating. That context can make the same development more sensitive than it would be in a quiet market. The affected group is not the same in every story. For borrowers, the model can unlock liquidity without selling Bitcoin, but trust depends on collateral storage and strict limits on reuse. The firm stopped lending multiple assets in 2025 to focus only on Bitcoin and uses regulated third-party custodians. This is why the strongest reading depends on the exact channel of pressure. For some stories, that channel is exchange access. For others, it is a balance sheet, a court filing, a wallet movement, a bridge, a vault, or a central bank signal. Here, the important channel is tied directly to a $188 million Bitcoin-backed asset-backed security and a lending model built around custody, reserves, and no rehypothecation. The unresolved part is narrow but important. The open question is whether other lenders can meet similar standards after the failures of the previous cycle. Ledn identifies massive should not be treated as proof of the final outcome until the missing piece becomes visible in public behavior: filings, product terms, wallet movement, or market data. That distinction protects viewers from reading too much into one move while still respecting the fact that the move can have real consequences. The next concrete test is future rated issuances, reserve disclosures, custody practices, and loan performance during Bitcoin drawdowns. The practical close is to track the observable signal that matches this exact story. If the signal appears, the event can move from initial reaction into a clearer market or user consequence. If it does not appear, the story may remain limited to positioning, operational changes, legal pressure, or short-term sentiment. If Ledn identifies massive keeps developing, that signal will show whether the event becomes a lasting shift or a short-lived market reaction.